OD Jacob here. Today we're looking at Cboe Global Markets. They are the capital markets industry, 17.8 billion market cap on 18.6 billion enterprise value. Growth has been very impressive over the last 10 years. Looks like might have been an acquisition in 2017. I don't know what happened. We'll look on the free cash flow statement, but growth the last couple of years has been pretty abysmal in comparison. Operating margin got trampled. So did gross margin with this acquisition here. So the bottom line has not grown as fast as the top line. But return on invested capital is still fairly solid. Let's look at what this 2016-2017 is. Okay, huge acquisition, $1.4 billion. Okay, interesting. They put some paid a lot for a huge top line, not as much on the bottom line increases, but they're starting to become more efficient, which is good for them. It does take a little bit of time when you make a large acquisition to really start to become more efficient with it. You're still trying to figure out the ropes and everything. Looks like they funded it through a little bit of debt, maybe a little bit of shares, and they've actually been paying down shares the last 7 years or so. They cost of goods sold is going to be your biggest hit to revenue, but sales, general admin, not much. Other expenses, not crazy. So pretty decent on the margin side. Balance sheet shows 543 million cash on hand, 400 or 600 million in all cash-like products. No short-term debt. 1.4 billion long-term debt. That 1.4 billion long-term debt is really no concern. That is a 2 years, maybe a little over 2 years of their 5-year average free cash flow. And so we're definitely not terribly concerned about that. Their use of free cash flow is a little bit on the reinvestment side, a little bit quite a bit of acquisitions. Their dividend pays out 229 million. That is going to be about 40% of their free cash flow for 1.3% yield, and then also a little bit to share repurchases. So let's start making some assumptions here. On the revenue growth side, it's definitely dampened down quite a lot. I think maybe just a little bit from reinvestment and acquisitions to get 5%. I think market average for capital market industry with this type of growth rate seems pretty reasonable to me. Earnings and free cash flow are quite a bit different. Maybe we'll do a bit of a range here with share changes of 1% would be about 178 million. Let's just offset stock-based compensation with about 10%, maybe even a little bit less. We haven't bought back too many shares recently. Dividend, is 40%. I think we can afford to increase that. Let's see, with about the revenue. So with similar margins, that should be a similar payout. And then again, we said we're leaving some money for a little debt reduction, but mostly reinvestment and acquisition to keep these type of margins and get a 5% return a year. We're saying the company's stock price needs to fall 63% before you get the return we're looking for here. So I will just be patiently waiting for this company and be reviewing other companies in the meantime. Thank you. Have a great rest of your day.